Welcome to the What to Watch video update. This is the final video that I prepare over the weekend where I pull out the charts to see, okay, what charts seem to be telling us something right now. And I break them down into three categories: positive, negative, and then a pretty long list of those things that we're just watching right now because they might be outside of the S&P 500, but they're either quite long term or they may react in one way that ultimately may have an impact on the S&P 500 itself. Where we're asking the question this week, will the S&P 500 experience weak seasonality? And this is being prepared for Monday, September 8th. Now, the reason I'm asking this question is pretty much since the middle of July, we saw a pretty significant decline in 2023, 2024. So we were watching for it in 2025. Didn't happen. Then August, we've never had a positive August during a post-election year going all the way back to 1950. We had one. We were up 1.91% for the month. Now, the worst month of the year is September. Is that going to happen? Now, we're still pretty early in the month. The market is kind of buzzing right now because it's pretty much a done deal that the Fed's going to cut rates. The only variable right now is how much. And the market's pretty much counting on a 25 basis point cut or a quarter of a percent, with then a rise in expectations that at the end of October, when they meet again, they're going to cut another 25 basis points. Now, we always want to know the context. Why are they cutting rates? Is it because the economy is doing okay and just needs a little tune-up, a little spruce, something for the markets to fixate on and help them go up? That's what it appears to be right now. But there's some folks out there, especially after Friday when we had the really weak employment report, and the market liked that initially. But then you've got folks thinking, okay, is the economy getting a little too weak now? And will they be cutting rates to try to stimulate the economy rather than fine-tune the economy? And that's kind of the context that we're dealing with. It doesn't appear to be that the economy is falling off a cliff. It appears that it's being fine-tuned, but that can change. And we're going to get some major economic reports this week. Now, one thing that'll be different this week than what we saw a month ago is PPI is going to come out first. And that was the report a month ago where we saw some unexpected inflation at the producer level. The CPI came out actually before that, and that was fine. And the market liked that. It was PPI that caught the market off guard. Well, this week we're going to get PPI first, and then CPI is going to come out. Usually CPI comes out first and then PPI. At least that's what it's been lately. But not this time, according to the economic calendar. So we're going to get some updates there. And what's going to be the action of the markets? Are they going to fear over and increase their fear over inflation? Are they going to be subdued as far as inflation? Are they still going to have confidence that the Fed's coming in just to tweak the economy by cutting rates? Or is it going to shift over to something more negative? We don't know the answers to any of those questions. And that's what I do in my analysis. We look at the charts for what they are: positive, negative, and even though you can read both positive and negative into most charts, but then I'm constantly asking questions. Okay, where do we go from here? Are we going to be positive? Are we going to be negative? What's going to turn the market more positive? What's going to turn the market more negative? Well, since we're coupling up with this potential weak seasonality, at least historically that's been what's happened, is it going to actually come through in price? We don't know that. We're just watching to see if something like that is going to develop. Okay, so let's go through the positive charts first. And this should actually be Monday. I'm not going to go back and fix this and repeat what I just said. Okay, so first of all, we had an up week, barely. We were only up 1/3% here, but we did have an up week, even though it was shortened by one day because of the Labor Day weekend. Now, if you go back to Tuesday, and I've been pointing this out in all the different videos, if you just look at the open and then the close, it doesn't look that bad. We actually closed above where we opened. Where all the damage came from on Tuesday was the gap down. Now, we've been seeing the futures rather subdued, but this is after a 3-day weekend. And the futures were pretty subdued, and then things went negative in Europe, and then they drifted over into the US, and we just had a lower open. But most of the real price action has been while the market is open. That's been a little different than what we've seen in the past. But we did look okay here as far as just the intraday action. And then we gapped up and then started to drift down on Wednesday, but then saw some strength coming into the close. And then things were turning more positive here on Thursday. This was more of a sustained upward move where we closed at the high. Now, going from the open on Tuesday to the close on Thursday, this looks pretty good right here. But there was probably some buy the rumor, sell the news, hoping that the employment report would be weaker than expected, and that's what came out. So the market initially reacted positively. We gapped up here, but then we set the high right after the open. And then a lot of those guys that bought on the rumor, they're selling on the news, and boy, did they sell. Took us all the way down. We didn't fall apart. We found some support here at about 64.50. And then we did close up off of the low as well, but we were able to hang on to the gains. Now, one thing that's positive, and I'll show you later on, is we're above the 64.68 level. That's the weekly pivot point. And for 3 weeks, that was acting as overhead resistance. We would get above it, but it matters where do we close on Friday? Where's the price level at that point? We hadn't been able to get above it. Now we're slightly above it. Not by very much, but it is improving there. So for right now, we're breaking above long-term overhead resistance. Okay, we're seeing an improvement here with our intraday growth and value charts. This is a 15-minute chart, and we're coming back up. Now, it would be even more positive if the blue line was above the red line, but the fact that they're both going up, that's okay too, and improving after we had been going sideways here for a little while. So I'm taking this more as positive. Even though we closed down negative, we opened up and then came down. I'm looking more here just since the beginning of the month that we're seeing an improvement right here. We're also improving with the intraday growth to value chart for the S&P. This is a 10-minute intraday chart where we were looking more negative. We were falling all the way down below these moving averages. Well, we were able to get above them and actually look a little bit more positive and get back above the moving averages now. So that's looking better there. Now, we're looking okay here, but not great. You're going to see a lot of that in these charts here. The growth to value ratio here, it's still positive, but not showing an awful lot of strength. We're just at the upper end of the rainbow. And then we look at value to tech, which is growth, and we had been coming down, and that's more positive for the market with this ratio. Well, we're bouncing back up just a little bit. But the bigger context is that this still continues to go down. It hasn't really shifted to going up yet, so I'm still keeping that positive for now. Large cap growth set an intraday all-time high here and still above moving averages and still looking pretty good. So it would be nice if this could really break out to the upside and show some more improvement. And this is one of the stronger areas of the market right now. We have the discretionary equal weight. That is looking pretty good. And we saw that about a year ago, where discretionary from late August into September until the end of 2024, it was the best performing sector in the market. Are we seeing something like that beginning to develop? We don't know, but we can just watch for that. And staples, are more defensive, where discretionary is more growth oriented, they're just kind of chopping along sideways, not really doing too much. So when we do a ratio between the two, this is actually looking okay. We were down a bit on Friday, but looking in the bigger picture here, this is looking more positive than some of the other ratios that we're looking at. And then here's the daily chart since we had an up week. We did have a down day on Friday, that's why it's red. You can make a case that we're setting a series of higher highs and higher lows, kind of not real clean here, but this is a fairly healthy looking chart pattern here on the daily side. We are in an uptrend with the blue line above the red line, and at least in Friday's session, we were above average with volume, but we have typically been below average with volume even after the 3-day weekend. And this is positive with the VIX still under 20 and under the moving averages. The line, that's the closing value. The bar, that's the open, high, low, close, and we're down below the moving averages there. So fear is not really increasing, at least yet. And we're still looking positive in the bigger picture. When we look at the advanced decline line based on price and volume, we ticked down a little bit on Friday. I'm looking at the bigger picture here, above advancing moving averages. and we're back above zero. Now, it's been really choppy when we look at the advanced decline oscillator. This goes over the last 10 periods, and we use this to see overextended to the upside or downside readings. Not an awful lot of conviction here as we work through July. That was the last time, right around the 4th of July was when we saw any real conviction, and we've just been seeing this trailing off. That's the positive side. Now you could see a negative divergence here where we've been going up with the S&P, setting a series of lower highs here since that time. So that's potentially negative there. But when you look at this chart and it's above zero, it's taken as positive. And now this you could also say is negative because we're actually declining with the 5-day moving average of the new highs, new lows. But you can see there's a lot more green here than red, and we actually saw an expansion of the new highs. That probably happened with the gap higher in Friday's session, so we didn't stay there, but it did trigger a new high for a number of stocks, and not really much of an expansion of the new lows. And we're starting to go back up with the 10-day chart, even though the 5-day chart is coming down. Our three smart money indicators looking positive in the bigger picture. Accumulation distribution above an advancing moving average. On a short-term basis, seeing a little bit of a negative divergence here where this has been coming down as the accumulation distribution has been going up. And we're coming back down slightly to the moving average here. So that could be taken as a little more negative. But then we look at smart money indicator number 2, the Chaikin money flow, continuing to go up with the green histogram and the red lines going up. That's positive, and the Chaikin oscillator. Now, this is positive since we've been going up. We did decline on Friday, but we haven't crossed back below the moving average. But a warning sign is this is a pretty extreme reading. Now, I put this green line on here, so there's nothing necessarily magical about it. I use it as a reference point and I go back, okay, where did this top out in the past? Well, we're actually a little bit above the green line right now. So we get a little bit concerned when we go above the red line. We get even more concerned when we go above the green line because it's like, okay, this really doesn't have much more room to run to the upside because this is an oscillator and it stays within a defined range. So it's positive for now, but be aware of this at the same time. And we spent a couple of days with the vortex, with the green line and the red line giving us the same value. Finally, we had an update, so we're seeing the green line above the red line. That is positive. Now, we're positive on all of our trend analysis charts, but right here in the short term, even though we're turning up, we're below 20. We're not seeing a lot of conviction. In fact, we're not seeing any conviction in the short term. We would lean to positive because of this chart with the green line above the red line, and we are looking okay here. We're not falling apart as far as price, but we're not seeing any real conviction with the short-term indicators that we look at. But we still default to positive here in the short term. Now here we're also seeing a weakening trend below the moving average, but we're positive with the green line above the red line. However, this has not fallen below 20. So we're still trending in the intermediate term, but it's not a strengthening trend. It's a weakening trend since this continues to decline. And then on the weekly chart, we're also positive here, even though the green line's coming down and the red line's going up. We're seeing the ADX decline below the moving average and also below 20. So in the short term and in the long term, we're not trending right now. We're still hanging on to a weakening positive trend in the intermediate term, but it's still positive on the surface. I just wanted to point out some of the concerns under the surface a little bit here. Now, we look at our moving averages. We're doing okay. We're above all three of these moving averages, and we closed above it even with the down day. So this is shorter term positive. And we look at the condition of the short-term trend based on 20 periods. We're still tending to go up. It's not looking all that strong, but it's not really looking negative either when we look at the blue line and the green line here. And then the intermediate term trend also looking a little vulnerable based on 50 periods, not showing an awful lot of strength, but not really turning negative yet either. And we did lose the 20 period moving average back on Tuesday. We gapped down below it with that lower open, and then it looked like, okay, is this acting as overhead resistance? Well, it didn't last very long. And we were able to get above it on Tuesday and then stay above it even with the decline. And now it's acting as support. And it was pretty much where the low was hit in Friday's session. And then all the moving averages here, we're still above the 20, 50, 100, and 200, and all the lines are going up. That is positive from a trend perspective. And after being negative for a couple of days with the daily parabolic SAR chart, we've now switched back to looking positive again. And the weekly chart, longer term, that is also positive since the dots are underneath. And even though we're not seeing an awful lot of strength here with those stocks above their 20 period moving averages that are inside the S&P, we're still above 50, even though we declined a little bit. Now, that's what it's at right now. But in the bigger picture, we've been going up with the S&P. We've been setting a series of lower highs here with this particular indicator. And that's what we're seeing in both the short and intermediate term. The long-term charts, when I get there, we're not seeing that negative divergence. So this is just showing a little bit more vulnerability in the short term. Also, a bit of a negative divergence here with the 50 period moving average study. That's the negative part. The positive part is that we are above 50. And now we're not seeing a real negative divergence here with the 100 period moving average study. And we're actually making a series of higher highs here with the 200 period moving average study. So this is looking healthier. It's more short and somewhat intermediate term that we're seeing more vulnerability right now. And then the daily special K chart, we are still positive here. And this is what I was really focused on. We closed above this R1 pivot point, which was at 68, excuse me, 64.68. And we're above it. We're at 64.82 if you want to round that up. Now we're not too far above it. Now, on the positive side, and I've been trying to point this out, if you look back in the past and we hit one of these pivot points, and sometimes they are a huge deal, it's where we see a major reversal. Even last spring, now we went below it, but this is about where the market made a stand and then came up out of that in April. The fact that we've come up here and we're staying around this level could actually end up being more positive. Because usually once we hit one of these points, we hit it and then turn and go the other way. We've been hanging around here for right now. Now, at the same time, anything can happen. And if we lose this again, we're going to be saying that we lost this. It's not really support yet because it just happened on Friday. We were above it on Thursday, but then we came back down here and we're a little bit closer to it after Friday. So you can't really call it support until it's been there a while. At least that's my take on that. But for now, this is looking more positive since we're above the R1 pivot point. And we're also positive here with the trend channel going back to 2009, but we're also at the upper end of this. And we've been here for a while. And when we hit this area, that's when things started to become a little bit more lethargic as far as price, but still positive nonetheless. And then I don't really put a lot of credence into this, but this is a praying bottom fisher signal that was generated back in the middle of August. And you could say, all right, would have been some scary times here, but this is still giving us a buy signal. Now, when we look at the advanced decline line studies across the market, we're holding up fairly well here. We're above moving averages with the NYSE common stock, the S&P, the mid caps, and the small caps. So that is positive in a bigger picture sense. And I wanted to show this because we're actually breaking out and setting a new high here with the NYSE common stock based on volume. That's breaking out to a new high. We haven't broken out to a new high based on price. Now, depending on your position on things, you could say, oh no, this is a negative divergence. Personally, I see this right now anyway as a positive divergence because when volume leads price, especially to the upside, that ends up being more positive typically. Not always, but typically. So in a broader market sense, this is taken as positive. Now, we're not really seeing new highs with the S&P, but this is a broad market common stock advanced decline line. And so that just means that the broader market is looking a little bit stronger right now. And then the NYSE McClellan oscillator, it's above zero. Now the S&P, it's still below zero. So the broader market is holding up a little bit better than the S&P right now. Now, even with this chart, you could also see the negative divergence where we've been going up with the S&P, setting lower highs here with the McClellan oscillator. Now, when this is above zero, and see how choppy this has been over the last couple of months, not so much on volume, but really based on price. We're going up a little bit here with the summation index based on price, and we're turning back up a little bit here based on volume for the NYSE, where we're negative with the S&P right now. Now, the Dow is still in an uptrend, kind of going sideways. And if you watch the deep dive video that I do, I take the 6 indexes that I follow, the S&P, the NASDAQ 100, the NASDAQ, mid caps, small caps, and Dow. The Dow's in last place. And even though it's just coming off of recent all-time highs here, it's not really looking good from a technical analysis perspective. It's just kind of chopping along sideways, but it's still positive nonetheless. And then the NASDAQ. looking pretty good here in an uptrend. Now, really choppy, hitting support at this pivot point, hitting resistance at this pivot point, came down to the 50-day moving average, was able to bounce up off of that. So this is looking positive, but very choppy right now. A similar thing here with the NASDAQ 100, holding at support with this pivot point, breaking above this pivot point for August and actually closing up a little bit off of that. And the trend is positive here. And the small caps, I thought I'd never say this ever again, but the S&P 600 is in an uptrend and we're actually looking to be breaking out a little bit. Now, small caps and mid caps like when the economy is still doing well, but the Fed still comes in and cuts interest rates. And that's kind of what they're latching on to right now. And then we have another small cap index, the Russell 2000. That golden cross was generated at the beginning of August. And this is looking a little bit better here, even though we closed well off the high. The bar pattern is looking more healthy, and we're up here with the RSI, and we're positive with the MACD. Mid caps also possibly breaking out here after spending a lot of time going sideways, but also closed well off of the highs on Friday. And then the Wilshire 5000, another broad market measure, set an intraday all-time high, but didn't close at a high. We did set a high, I think that was on Thursday. It's kind of hard to tell. Pretty equal there, at least on a closing basis. And the total US stock ETF, this is another broad market measure, still looking quite positive there. Financial sector, again, I've been saying this for such a long time. You look at this chart by itself, looking okay. Now, it got hammered pretty hard on Friday, and it didn't like the employment situation report and then saw some selling, but we're still above the 50-day moving average. What's been the concern going back to spring, about May or so, we've been seeing a real breakdown in the ratio between the financial sector and the S&P. And that ratio has been really going down enough to generate a death cross. Then we were getting some hope here. We were seeing this ratio coming back up, and it pretty much gave all that back, or at least a lot of it, back in Friday's session. So it's the reason why this is on the positive side is because of this chart. This could actually be on the negative side, but I wanted to keep those two charts together. And then the banks looking pretty good here, but look at the pattern on Friday. We opened, we went, we set a high, and then we closed down below that. That's not a real confidence building bar in and of itself. But recently, higher highs, higher lows. So there's some positive and negative that you can take away from this chart. And banks are, of course, part of the financial sector. Now, this is actually showing some improvement. These are regional banks, smaller banks, compared to the financial sector. Now, the financial sector got hit hard on Friday, but it is in an uptrend when you look at it by itself. And the fact that this ratio is going up, that is kind of nice for the market to see this improving. And I've said this in other videos, and I say this from time to time. When this really took a dump back in 2023, this was when Republic Bank and Silicon Valley Bank said, uh-oh, we're having problems. And then we kind of stabilized. And then we saw another big dump back in early 2024. That's when New York Community Bank came out and said, we're having problems too. And we've been just kind of waiting to see, okay, are there other banks that are going to come out and say this? Well, to this point, not really. It's not like they're looking great, but they're not at least making these really bad announcements either. And we could be seeing a bit of an improvement here with this overall ratio, enough to maybe generate a golden cross with the ratio. And the FANG index, this is where the strength came from. You had Google and Apple that were up, and they pretty much controlled the market last week. And they're part of the FANG index, the really big stocks, and setting an all-time high. And that's positive there. Now, we are seeing a bit of a lag here with semiconductors, down to their 50-day moving average, not really breaking out, not breaking down either, but just kind of lagging right now. And then the other semiconductor ETF, not really showing any strength, but not showing an awful lot of weakness either. And so we're just kind of chopping around here. I could have put this on the negative side, but we've been kind of going up here. When we look at the semis to tech ratio, we want the semis to outperform the tech sector. That's when the market really gets moving. Okay, and then the Qs, the small caps, coming down a little bit since small caps had a good week, but we're still above this blue line. And then I should have had this earlier. The semiconductors, again, positive overall because we're at the high end of the rainbow, but not really showing any strength either. Then the semiconductors to Dow ratio, this is a growth to value kind of proxy for that. Kind of choppy here, but in the bigger picture, we have been going up with this ratio lately in the recent past. Then we have some stock to bond ratios, and these are holding up okay. We'll see some weakness as we go through these charts, but this is the S&P to 3 to 7 year bonds. And when we're up in this area, that means the market is not anticipating a recession. That's called a soft landing. And that's still holding up. Now, this is just an inverse of that same chart we just looked at, showing how bonds are underperforming stocks. Then we look at the S&P 1500, the short-term bonds, still looking good there. Broad market measure, the 3 to 7 year bonds, looking good there. Now we see a little bit of lagging. When we look at the Qs, the 3 to 7 year bonds, not, I mean, they're not negative, but not looking all that strong right now either. And then the tech sector lagging behind a little bit here. This is the major growth area, and we want that to be outperforming to be even more positive. And then this has turned more positive. We're above the rainbow now. When we look at home construction, the 3 to 7 year bonds, this started to break down at the end of 2024 and just go down, 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 down. Then it set up some kind of a base, and now it's been starting to come back up. Home construction, very interest rate sensitive. It likes that the Fed's going to come in and cut rates. So we've been seeing some general improvement with this overall ratio. Long term, still above this trend line with the NASDAQ 100 weekly chart going back to 2009. And then here's another growth to value ratio. Took a bit of a hit, but still above this red line when we look at the NASDAQ 100 to Dow. Now we go over to the negative side. And now we're not necessarily negative with sentiment when we look at the fear and greed index, but we've been coming down. In fact, we even saw this going down on up days. It's like, okay, what's going on here? Since when we're not getting an extreme reading, we tend to go with the direction. And that's why I have this on the negative side. And here we are setting all-time intraday highs in Friday's session, and this is neutral right now. Not what you usually see right here. Then small caps. Now, we're still positive longer term, but you can see there's been a real breakdown here as small caps have finally started to go up. This ratio has been going down when we look at the growth to value ratio here. Also, we're below the 50-day moving average and now going sideways. Mid caps have been doing better, but this ratio has actually been showing some weakness. And then S&P growth to value. We're below the 50-day moving average here. Bigger picture, we're still positive. This weakness started to come in back towards the beginning of August, and we've been seeing a little breakdown here as the market has been getting more defensive. Now it's kind of stabilized right now, but we need this ratio to go back up to be more positive for the S&P. And then we look at a number of growth to value ratios. The Qs to S&P, you don't want to be below a declining moving average. Now, discretionary to the S&P, this is one of the stronger areas of the market. That's positive. But we're back up to a declining moving average when we compare large cap growth to value. And so we're a little bit above the moving average here with the large caps, still below the moving average with the mid caps and the small caps. So that's not showing an awful lot of strength or confidence. And then this is the McClellan oscillator for the S&P. Even though we advanced, we're still negative here. So we're declining just a little bit here based on price. There's a little bit more conviction here based on volume. So that's why this is on the negative side. Now we're getting a mixed picture here. We're actually going up a little bit with the Swindler Trading Oscillator, but we're declining based on volume. You want to see these two going in the same direction at the same time. That's why I put it on the negative side. And momentum is still negative. Short, intermediate, and long term, we're still declining with all of our oscillators. And here's another oscillator too, which is also continuing to be negative, the Copic curve. And we're declining below the moving average with the bullish percent index for the S&P. We're still above 50, so that's positive. But when this goes down below the moving average, I count it as negative. Now, this is actually positive, but I wanted to keep the three bullish percent index charts together. This is above 50 and going up, and that actually advanced on Friday where the S&P went down. But then another concern too is that the NASDAQ 100 bullish percent index, even though it improved, it's below 50. And you can see as we've been going up here with the S&P, we've been setting a series of lower highs here with the bullish percent index, not showing an awful lot of point and figure buy signals right now for the NASDAQ 100. And we're seeing less buy signals for the S&P 500. Then this was positive. Now it's kind of turned back to negative. This is very long term. It's the NYSE Zahorchak method, so it's a broad market measure. We spent most of 2024 being pegged at 10. Then we saw the weakness coming last spring. We fell down to 0. Then we came all the way down to -10. Now we went back up to -6, and then we got up to 0. And then in the latest reading, we came back down to -6. That's why this is on the negative side. And we're still negative with the momentum. And we've been negative since pretty much Memorial Day here for the NASDAQ 100. And even though small caps are kind of seeing some favor right now, they've got a long ways to go to start outperforming the S&P. They need to come back above both moving averages, see this sustained ratio go up enough to turn that into a golden cross. And we've seen that before. Here's the Santa Claus rally at the end of 2023. We saw another nice move in 2024, an attempt at a Santa Claus rally here, and then it fizzled out shortly after that. Is it different this time? We don't know right now. We're just asking that question. Then the areas that I'm keeping an eye on. Now, weekly jobless claims, they did go up, but we're still within a range that we've been in here for about the last year or longer. So, yeah, we're concerned that they're going up, but they're still range bound more or less. Then we're also range bound here. Now, continuing claims came down, but we're now up in a higher range than where we were earlier in 2025. These are folks that are unemployed longer, and this is a bit of a concern from the employment perspective. So we're coming down a little bit here with the continuing claims, up with the initial claims, and then the unemployment rate went up to 4.3%. And then the skew index. And again, we don't know if this is predicting a big move up or down. It's just we've been up in this red area now for a number of days. The market's still anticipating some kind of a big move, but we're not quite sure what that is until this finally comes down. And that's why I have these arrows in here. Sometimes it's a top, sometimes it's a bottom, sometimes just a continuation. And not really seeing a lot of conviction right now. So we're just watching this. The risk on to risk off ratio, just kind of blah, 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 bouncing around all over the place and just kind of not really showing a lot of conviction. Now, the bigger picture is this is going down, and that's positive. That means staples are underperforming the tech sector. That's what we want in a more positive environment. But we got into the summer and we're just kind of playing bumper cars around here a little bit. And we're seeing kind of that same thing more recently here with the staples to S&P ratio. Going down is positive, but now it's just kind of hanging out at the same level. And then the high beta to low beta ratio, not really showing a lot of conviction. It did go up on Friday, but we've been kind of range bound for the last few months. And now this, I haven't shown this in this video for a while. These are riskier bonds like junk bonds, and they've been doing quite well. But government bonds have been really coming on strong lately, and that's causing this ratio to come down a little bit. Now, junk bonds tend to follow the stock market, and if we're going to see less favor for junk bonds and more favor for government bonds, that may end up putting some pressure on stocks as well. Just a theory to throw out there. And we've really been coming down with the 10-year yield. We finally broke below this more recent bottom range that we were in. And now we've even dropped below this range and we're continuing to go down here. Now that's taken as positive, but at some point this is going to become oversold and we're going to see a bounce back up, which means bond prices are going to top out and start to come down. We're not quite sure when that will be, but right now we're just seeing interest rates really going down. Now I want to look at some ratios to see, is the market concerned about inflation? This first one looks at cash to 3 to 7 year bonds. When this ratio is going up, the market is concerned about inflation and interest rates. Well, you can see in the short term anyway, this ratio is really going down. Now we did go up a little bit here, but we're still range bound when we look at tips to 3 to 7 year bonds. When this ratio is going up, folks favor tips, Treasury inflation protected securities, because they adjust and they're shorter term. If interest rates have topped out and are starting to come down, folks are going to favor 3 to 7 year bonds. So we haven't really seen an awful lot of conviction, but we are starting to generate a golden cross with this ratio. Now this actually went down, like this previous one went up. Longer term bonds, tips to 7 to 10 year bonds, that's going down, but still pretty much range bound and not showing an awful lot of conviction right now. And we are declining short term, the 2 year treasury yield, that's helping things. We're setting a series of lower highs. You could maybe make some kind of a case for lower lows here, but really it's lower highs that kind of stick out on this chart. And then we're declining with even shorter term with the 3 month yield. Now, we've been going sideways here for a lot of 2024 into 2025. Now we're really starting to drop down. Now, that's okay if interest rates are coming down, but this also happened back in 2007 going into 2008, and that took us into the great financial crisis. Now, it doesn't look like this is really acting crazy right now, but so we're taking it as more positive for the time being, unless we get some evidence to suggest, okay, the economy's falling off a cliff. There are problems somewhere out there that haven't worked their way into the market yet, and that's why we're seeing these rates coming down. And we just want to keep an eye on the spread between risky and not as risky bonds. Not really much of a change here. When this goes up, that means there's less fear. And the S&P to utilities ratio, which it had been chopping around an awful lot, now it's going up right now. That means the S&P is outperforming. This isn't really due to recent strength in the S&P. It's due more to weakness in utilities. So we'll keep an eye on this. Now, when this really shows some conviction, that's when I put it on a positive or negative side. But we go up and then we come down and then we go up. And there just hasn't been a lot of convicted movement here. And then this was looking more positive, but now we're seeing some weakness coming in, and this is longer term. A 10-day average of the highs and lows for the S&P. We were above the green line. Now we're starting to come back down. That could potentially be longer term negative. And then we're still looking good here, though, when we take a 5-period moving average of the highs and lows across the broad market. This is continuing to go up. It's off of its highs, but it's still well above zero here. And then we're going to see if this is going to continue. When this is going up, the large caps are outperforming. When this is going down, the small caps are outperforming. Now, small caps are seeing a little bit of favor right now, so we're seeing this ratio continue to decline. But we've seen this before, and then it stopped and went the other way. So we'll just continue to watch this. And then oil has been coming down, and we're getting into the low 60s there. And we want to keep an eye on the dollar. And as I've been saying all along here, the dollar weakness, that's really where the strength in stocks have come from since we saw that big dump back in April. And the dollar started going up and then it started going down, and that's helped stocks to go up as well. Stocks like a weaker dollar, and we're still not doing very well. If you look at the weekly chart, we're also in a downtrend there as well. Now, retail is showing some improvement here. When we look at the ratio, this top chart is the retail sector of the S&P, and we were underperforming here for a long, long time. We started to base a little bit, and now we're starting to go up. Now, we'll need to see more follow through than that. But then when we look at retail by itself, this is positive. We're above the moving averages. We're in an uptrend. We're above 50 with the RSI and going up. So that's showing some improvement there. Now we want to keep an eye on different ratios. The top area, that's the weighted discretionary to weighted staples. When you're talking about discretionary and the weighted version, that means Tesla and Amazon. And this is still doing okay here. And then you look at an equal weight version, that actually went down a little bit more on Friday because instead of Tesla and Amazon counting for everything, they treat all the stocks the same here. But this is still looking okay. This is a better looking area in the market. Not really seeing much of an improvement, but not a breakdown either. When we look at tech to utilities, we are seeing an improvement with biotech to healthcare. That's another growth to value ratio. And then hotels, which are discretionary to utilities, something you have to have, that came down a little bit, but in the bigger picture, that's looking a little better. Then we look at bellwether industries here. Semiconductors, not falling apart, but not really showing any leadership right now. Home builders are looking a lot better. A little bit of an improvement here, but still pretty much range bound with the transports. And we are improving with retail, as I pointed out earlier, and seeing a little bit of an improvement, but closing well off of the highs with regional banks. Okay, and then we want to keep an eye on the gold to S&P ratio. This went up because gold's going up. It's breaking out right now. The S&P was up, but not by very much, and that's why this ratio went up. And we look at US to international stocks. We have been drifting higher. Now we're starting to level off again here. And then momentum stocks, they held up much better when we were going down, but they've been underperforming since we've been going back up. And also going sideways here, when we look at the ratio between emerging markets and developed markets, not really a lot of conviction after spending the early part of 2025 seeing the emerging markets actually underperforming developed markets. And developed markets would be the US and European markets. And then Germany, below its 50-day moving average, not falling apart, but seeing some weakness here. And that's helping the US to German ratio actually improve overall. And this is just mainly for informational purposes because the US stocks really underperformed at the beginning of 2025. Then they went all over the place here. They've been coming back. They haven't assumed a leadership role yet, but they are improving when compared to German stocks. And then these are the pivot points for Monday's session. They're already available on the website that I have. They're also available on the YouTube community tab, and they can be quite important as guides for support or resistance. Thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.